The EARS doesn't treat every taxpayer the same, and it's not just your tax rate that changes as your income climbs. Your refund timing changes. Which credits you can claim changes. Even your odds of being audited change, and not in the direction most people assume. Today, we're walking the entire staircase, from the lowest income tier to the highest, using the actual 2026 IRS numbers at every step. What you owe, what you can claim, and how closely the IRS is actually watching. Tier 1, under $25,000. At this level, the 2026 standard deduction of $16,100 for a single filer already shields most or all of your income from federal tax outright, if you qualify for the Earned Income Tax Credit or the Additional Child Tax Credit. The IRS is legally required to hold your entire refund, not just the credit portion, until mid-February, every year, no exceptions. It's a fraud prevention rule, but it means the taxpayers who often need their refund fastest are the ones required to wait longest. There's also a counterintuitive audit fact here. Overall, the IRS audits roughly 1 in 200 returns. But taxpayers who claim the Earned Income Tax Credit are audited at roughly triple the average rate of everyone else, even though this tier has some of the lowest incomes on the entire staircase. Tier 2, $25,000 to $50,400, the top of the 12% bracket for a single filer in 2026. Refunds here usually aren't held to mid-February unless the Earned Income Tax Credit or Additional Child Tax Credit is still in play. This tier is also where a credit called the Saver's Credit becomes realistic. It can return 10, 20, or even 50% of retirement contributions as a direct credit, depending on income, on top of the retirement benefit itself. Most people at this income level have never heard of it. Tier 3, $50,400 to $105,700, the 22% bracket for a single filer. This is, statistically, the quietest tier on the entire staircase. IRS audit attention follows something close to a U shape by income, elevated at the very bottom, elevated again at the very top, and lowest in the broad middle where most taxpayers actually sit. If you're in this tier, you are, on average, the taxpayer the IRS is least likely to look twice at. Tier 4, $105,700 to $201,775, the 24% bracket. This is where the tax picture usually stops being just a paycheck. The 0% long-term capital gains rate, available to single filers with taxable income up to about $49,450 in 2026, is already out of reach for most of this tier. Investment gains here are typically taxed at the 15% capital gains rate instead, a meaningfully better rate than ordinary income tax, but no longer free. What's this extra Medicare line? Tier 5, $201,775, up to $640,600, spanning the 32 and 35% brackets. This is where 2 extra separate taxes usually show up for the first time, and they aren't part of the regular bracket table. Once wages or self-employment income pass $200,000 for a single filer, an additional Medicare tax of 0.9% applies to the amount above that line. Separately, a net investment income tax of 3.8% can apply to investment income, dividends, interest, capital gains, once income passes roughly the same $200,000 threshold. Unlike the regular tax brackets, neither of these thresholds is adjusted for inflation, so they apply to more people every year as incomes rise. Neither tax is enormous on its own, but together, they're a real, easy-to-miss 2 tax combination that starts affecting people well before the top bracket, often the first sign that a tax return is getting genuinely more complicated. Tier 6, above $640,600 for a single filer, $768,700 for a married couple filing jointly, the top 37% bracket. One 2026 rule specifically targets this tier and no other. Taxpayers in the 37% bracket now face a limitation on the tax benefit they get from itemized deductions. The deductions themselves are still allowed, but the value they return is capped in a way that doesn't apply to any bracket below it. It's a deliberate design choice. The top bracket doesn't just pay a higher rate. It also gets less benefit per dollar of deduction than everyone else. Tier 7 isn't a tax bracket at all. Brackets stop changing above $640,600, but audit attention doesn't stop climbing. Filers reporting income over $1 million face something closer to a 1 in 12 audit chance by some recent estimates. And filers over $10 million face audit rates cited above 20%, the steepest part of the entire U-shaped curve. This isn't random. Treasury guidance has specifically directed the IRS to concentrate enforcement on high-income filers, partnerships, and large corporations, while holding audit rates on small businesses and taxpayers under $400,000 at historical levels rather than increasing them. The wealthiest taxpayers on this staircase are, by policy, the most closely watched. One correction before the recap, because it's the single most common misunderstanding about every tier on this staircase. Your tax bracket is not the rate you pay on all your income. The U.S. uses a progressive system. Moving into a higher bracket only raises the rate on the income inside that bracket, not on every dollar you earned. A single filer with $200,000 of taxable income in 2026 doesn't pay 32% on all of it. They pay 10% on the first slice, 12% on the next, and so on, only reaching 32% on the portion above $201,775. Their actual effective rate, averaged across the whole return, ends up meaningfully lower than their top bracket. Every tier on this staircase pays less, in practice, than its bracket label suggests. Under $25,000, the standard deduction shields most income, but earned income tax credit claimants wait until mid-February and face a higher audit rate than the average taxpayer. The broad middle, roughly $50,000 to $100,000, is statistically the quietest tier on the return. Past $200,000, two extra taxes, additional Medicare and net investment income, start applying, neither indexed for inflation. The top bracket loses value on its own itemized deductions. And past $1 million, audit attention climbs sharply by policy, not by accident. Wherever you sit on this staircase, remember, your bracket is a marginal rate, not your real one. This video is for educational purposes only and is not personalized financial advice. All bracket, deduction, and threshold figures are for tax year 2026 per IRS Revenue Procedure 2025-32. Audit rate figures are estimates from secondary reporting and should be verified against the official IRS data book. Consult a tax professional for guidance specific to your situation. If that made the tax code feel a little less like a black box, subscribe. New videos every week on the personal finance topics school never covered.